Hey everybody, welcome back to Dividend Stockpile. I am very excited to welcome a very special guest, Meb Faber. Meb is a co-founder and chief investment officer of Cambria Investment Management. He's the host of the Meb Faber Show and an accomplished author and researcher in the world of investing. He's built his reputation for taking deep dives into the markets, global asset allocation, trends, and income strategies. And today he's here to share his insights on dividend investing and income investing with our community. So Meb, welcome to the show.
Great to be here.
Yeah, I really appreciate you coming on. I've been following your podcast and your work for quite a while, and I really love your insights, and I think that the audience will love your insights as well. Can you give us a little intro about yourself and kind of your background is and how you started Cambria and anything else you wanted to share with us?
Sure. I was smiling as you were saying, I've been reading your stuff for a while because I think, we started this company 20 years ago. I don't feel that old. I may look that old, but I don't feel that old. So anyway, yeah, we, didn't quite know what we wanted to be when we grew up. Started out managing money. Here we are 20 years later, and we're an asset manager. We got over 100,000 investors all around the world, about $3 billion in assets, soon to be 19 and 20 different ETFs. Our calling card, as you mentioned, you probably found us through our research, and that's sort of morphed over the years. It used to be old school academic papers and blogs and books. In the more modern age, that's things like podcasts and streaming and probably less Twitter and LinkedIn, but yeah, we still put out quite a bit of research, and hopefully a new book soon. It's been a little while since we've done one of those, but we try to only launch funds and ideas that don't exist or we think we can do much better, much cheaper. And I put all my public assets into our ETFs, and yeah, that's the quick summary.
Yeah, Cambria definitely has a lot of different ETFs available, all with very unique strategies, and I'll pop some up on the screen today, and we'll talk about a few towards the end of our conversation today. But what I really like about what you do is you invest in quality companies, but you're looking at more than just dividends and dividend payments themselves. You take a more broad approach. A lot of dividend investors look for the highest yield or the flashy new income ETF, but they don't look at the big picture or the total package. And it feels like your strategy is more of that total package. So can you, on a very high level, kind of give maybe like a pros and cons to your traditional dividend investing? And then we'll dig into some of your examples of how you like to look at it differently.
Sure. If you think of the long history of investing, what's the most important thing? It's saving and investing in the first place. I like to get that out of the way because as professionals, we love to sort of debate the final 10 or 1%. And most people kind of overlook the big things. And so save and invest is a big one. Do it tax efficiently with a mindset on cost. It's the best time ever to be an investor. There's limitless choice at the grocery store, thousands of different ETFs you could choose from. That also gives you a little paralysis, of course. And so, are you going to pick Frosted Flakes or Grape Nuts or Wheat Bran or oatmeal? And so as you look at this menu, for the long history of investing in the stock market, meaning buying something like the S&P 500, has done great. No question. People will look at that today and they'll look at their SPY and they'll say, well, it only yields 1.2%. Lowest ever was a 99 at 1.1%. Okay. At one point, it had a 13% yield, which is crazy to think about. And they say, well, where have the dividends gone? And so people say, well, okay, I'm going to search for dividend stocks. I'm going to look for underlying stocks that may yield 2%, 4%, 6%. And dividends have worked great forever. Now, what you have to understand when you do, quote, dividend investing, you're searching for dividends, it's simply a company paying out part of their cash flow to investors.
Yeah.
And if you're an investor that's young or an investor that wants to get that historical, let's just round and call it a 10% stock return, you have to reinvest those dividends. You can't just go spend them, right? If you want to go to that vacation in Cabo, you're in Florida, so it's more Caribbean. You want to go down to the Bahamas, you want to sip pina coladas on the beach, great, but you're not going to get 10%. So let's be clear. If you're spending that income, and that's okay. Like if you're a retiree, you're living on that income, that's what you want to do, good for you. But to get that historical return, you have to reinvest the dividends. So what's changed? And historically, if you invest in high yielding dividend companies, it beats the market, let's call it by about 1% or 2 per year for a long time. Now, the problem with that is historically you get a little bit junkier companies. They tend to have a little more debt. But what the reason dividend investing works is you're getting a value tilt. So they tend to be cheaper in terms of valuation, things like PE ratios, than the overall market, which, by the way, today we think is one of the most expensive it's ever been in history. Okay.
Yeah.
Not a
Yeah.
good thing. But dividend usually gets you a value tilt. But, and here's the asterisk, right? And this is kind of what we've been known for. My very second book, Shareholder Yield, second edition now. You can find it, the ebook, most of my books free online if you go to my blog, Meb Faber. But you hear so much online, people talking about this time is different, this has changed, the Fed's doing this, blah, 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 this is new. And very rarely, if you look at the long history of markets, and I'm not talking just to 1900, I'm talking to 1600, when the first joint stock companies were founded in Amsterdam in the Netherlands. You look back at the long history of markets, you start to see all sorts of crazy stuffs happen. And very rarely are there actual structural changes, but particularly in the US, and this is now global, there was a very real structural shift that happened starting really in the 1980s, accelerating the 1990s. And that was companies started paying out more of their cash flows by buying back stock than paying out dividends. Now, this is like the number one most misunderstood idea and concept in almost all of investing when it comes to buybacks. People's brains just melt down. We have a whole new chapter in our book on myths around buybacks. The first one people love is buybacks used to be illegal. They were never illegal.
Yeah.
Second is that if you could go back in time and reframe buybacks as either tax efficient dividends or flexible dividends, it frames it in a totally different way. In the same way that people used to call life insurance death insurance, right? Nobody wants to buy death insurance. I'm going to die. Who cares about that? But life insurance sounds good. Same thing with buybacks. If you just called them tax efficient dividends, because at their very basic, if a stock's trading an intrinsic value, it's the same thing as a dividend. Now, why are companies paying out much more of their cash flow in buybacks than they do in dividends this day and age? Now, the sort of media answer would be those greedy CEOs, they're buying back stock to push their stock up. And the real answer, the thoughtful answer, is you start to dig into the data, and we kind of demonstrate this in our book. CEOs turn out to be no dummies. And so when a stock is cheap, and you could use whatever valuation metric you want, and particularly really cheap, CEOs tend to buy back their shares. When a company is expensive, stock expensive, they tend to issue shares, right? So you have this natural arbitrage. Buffett has written about this more than anybody. He was writing about this in the 1980s. You can go look up some of his letters. And he's like, if there's a CEO and they have a stock trading far below intrinsic value, there's no better use of cash than to buy back their own shares. And Berkshire's done a bunch of that. The last couple of years, they have a thoughtful approach. They have a valuation metric. They say, we'll buy back Berkshire at 1.3 times book. Now, to be clear, Berkshire doesn't pay a dividend. Now, and the reason why is Uncle Warren says, I don't want to pay taxes on those dividends every year. Doesn't mean it's a bad company. Doesn't mean it's a bad stock. It just means he understands there's some capital allocation decisions to be made. And it's not necessarily good or bad in between.
Yeah. So to your point, CEOs and board of directors have, only certain things they can do with their excess cash. They can buy back shares, they can pay a dividend, they can pay down debt, they can go reinvest in the company, like do acquisitions, things like that. So they have to make that decision of what they're going to use that for. And to your point, back in the day, they used to pay that to dividends as dividends to their shareholders. But over the last couple of decades, as you mentioned, there's more growth opportunities, maybe internally, that they can grow their business as opposed to paying it out. And so that's definitely been a big focus. Like if you look back, it used to be the majority of companies paid really high dividends. And that's what a lot of people even invested for, is for the dividend. But now it's really changed. Now that you have all these high-tech growth names, things like that, they're much more hesitant to do dividends, but they'll still do the buybacks. And, the taxes definitely makes a big difference on that.
I was going to say, one of the key considerations here too, though, is even if you were ignoring the buybacks part, there's also the other side of the coin of buybacks, which is share issuance. And so even if you're a dividend investor, we often tell people you have to take into account share issuance, so the
Yep.
total shares outstanding, because you could think you buy, look up, I screen for a stock, I got this fat, juicy 4% yielder. Oh my gosh, I'm gonna chill out, retire on the beach with this one. And then if you don't pay attention to share issuance, for example, theoretically, this doesn't happen that often, but it does. This company could be issuing, say, 5% share dilution a year by giving stock-based compensation to their traditionally C-suite. This happens a lot in California, it happens a lot in tech. And you actually now have a negative yielding stock. And
Yes.
most people haven't heard of this. And the average stock out there is actually a share issuer, because a lot of the smaller companies, a lot of the younger ones, they're funding their business not from internal operations and earnings, but from share issuance, IPOs, things like that. So what we call shareholder yield is cash dividends plus net stock buybacks, right? So those two things combine. And in the United States, there is a bigger culture of buybacks than there is in other countries and around the rest of the world, though that's changing very quickly. You're seeing it accelerate in places like China, UK, particularly in Japan. But historically, they've had more of a culture of cash dividends than the US does today. But so going back full circle to the beginning of our conversation, if you look at that S&P dividend, 1.2%, it's a little bit of a mirage, because if you incorporate the shareholder yield, and meaning the buybacks component, it's much similar to historical levels. You just have to learn to look in the right places for it.
Yeah. So the tax implications for both companies and investors makes a big determination on which one's the better thing. When it comes to buybacks, the companies don't have to pay tax on it. But if they pay out a dividend, they're paying taxes, and us as investors, depending on the type of account we invested in, have to pay taxes on it. So I understand like why the companies want to do buybacks. But what do you say to investors who are like, well, I don't ever plan on selling my shares, so what good is a buyback?
You got to remember, and Buffett used to talk about this when he would talk about, he said they paid out a dividend once, and he jokes he was in the bathroom when they decided to do it. This was like 50 years ago.
Yeah.
And he says, look, the best thing you can do with your Berkshire certificate is take it out of the lockbox, fondle it, and put it back. But then he would say, look, if you want a dividend, you want a 5% dividend, you just sell 5% of your Berkshire each year and you create a synthetic dividend. So there's certainly ways for stocks that don't pay dividends to create a similar income stream or yield if you really want to. That having been said, if you think about buybacks, you hit the nail on the head. The job of the CEO, and one of my favorite books, if y'all haven't read it, it's called The Outsiders. And this looks at a bunch of different companies historically. The job of the CEO is to maximize those levers and find the one that generates the best return on investment. Hey, if that's you reinvesting in the business and making AI smart glasses like Meta's doing, great. If it's you saying, hey, look, we have really high cost of debt, we're over leveraged, we're going to pay down debt, great. The media loves the sexy part, the services, the new products, the launches, spaceships that SpaceX is building, yada yada.
Yep.
But if your stock is trading at, say, 50 cents on the dollar, and this business more than anyone in the world, you just happen to be out of favor, I don't know, the market's not appreciating something, you have some amazing products coming out next year, it's an amazing idea to be backing up the truck and buying shares.
Yeah.
Right? Because you're picking up dollars for 50 cents. And that becomes a valuation arbitrage too. And I think the same is true on the flip side. If your stock's trading at 200 times revenue, like some of these crazy companies are today,
Yep.
you better be issuing shares. Like, good for you. Like, somebody's buying them. And so I think, that's part of the idea. And so we manage 5 different shareholder yield ETFs. The average stock that's coming into our funds, if you think about a dividend yield, and most people are like, oh man, 4% yield, amazing. The average stock going into our funds has a double-digit shareholder yield, meaning over 10%. Now in the US, that's majority buybacks. In foreign and emerging, it tends to be about 50-50. You end up with a much higher dividend yield. And if you're an investor and you're looking for pure dividends, we often tell people foreign and emerging is a great place to look. I look a little smarter this year because foreign and emerging are having a monster year. I look less smart for the last 15 years because the U.S. has creamed everything else in the world. But being a global investor, I think in 2025 is important, and there's certainly much higher dividend yields elsewhere than there is in the U.S.
Yeah, I definitely been focusing on the international markets myself this year, both developed and emerging markets, because that's definitely where their value is, and that's where the growth has been over the last few months to a year and a half. So we have an investor. So ultimately, we're all looking for total return. That's the goal. That's what we should be focusing on, and we shouldn't care about buybacks versus dividends. So when you're looking at a non-taxable account, though, and you're getting those dividends out every month, for a retirement account or whatever happens to be, why would you not want to get a dividend where you can control where that money goes, as opposed to relying on the management to do the right thing, to reinvest at the right time, and, to create good value where maybe you could do it yourself, or you feel like you could do it yourself better, or you'd rather just have that cash in hand that you can use for yourself. What's the what's the trade-off? What's the purpose?
So if you look at some of our ETFs, we're only buying 100 stocks out of thousands and thousands of stocks. And I always smile to people about reinvestment and getting dividends and reinvesting them, because I often say, well, if you don't love the stock, why do you own it in the first place? And they say, well, I'm worried the CEO is going to be buying back shares that are expensive. And I say, well, why are you owning expensive companies? Like some of these ideas.
Sure.
So anyway, it's hard to know what's going to work when. I think the vast majority of the academic research is interesting. I was debating, conversing with Mark Cuban on Twitter not too long ago, because a lot of people, I think, struggle with this concept of buybacks. And he was saying, well, we got to raise taxes on buybacks. And I said, just to be clear, they're already taxed 4 times. I think a lot of people misunderstand how companies are taxed. But I said, also, by the way, the vast majority of the buybacks, when people sell their stock of a company that's buying back shares, it gets recycled into smaller, faster growing companies. Usually a lot of the companies. So we held Apple from 2013 to 2020 in our SYLD fund. And, eventually Apple got too expensive. But when you're a company like that scale and you're generating that much cash, they're a perfect test case and use case as to why you should be agnostic as to dividends and buybacks, because they did both. And they would never show up on a screen if you just did dividends or you just did buybacks. But the holistic shareholder yield measure, we think, is more thoughtful. So I tend to be somewhat agnostic, but if someone came to me and say, hey, look, Meb, I buy 20 dividend stocks, I hold them, I'll say, God bless you. That's great. It goes back to the earliest part of our discussion, which is, I think the most important base, laying the foundation, is more important than kind of the tip of the pyramid. But to each his own. I think the challenge comes with, we all want to be in a tribe. I'm a Broncos fan. I imagine you like the Bucks. I don't know. And I would never cheer for Tampa Bay, but it gets dangerous when it comes to investing, because a lot of people get attached to not just the stocks they own, but even the asset classes. They say, I buy US stocks. I say, okay, well, just so you know, like, that can go a long time not working out. Ditto with gold, ditto with Bitcoin, ditto with real estate, fixed income, on and on. And so dividends, like many other ideas, same as shareholder yield, they'll go through periods where they look amazing and periods where they don't look so amazing.
Yeah. And dividend investors are definitely very strong-minded when it comes to our strategy. Like, we feel like dividends are the way to go. Having that monthly income come in, or quarterly income, where you can go and do whatever you want. To your point, sit pina coladas on the beach if you wanted to.
Yeah.
The argument against share buybacks from the hardcore dividend investors is that you're still relying on the share price to go up over time. You're not as in control of the share price being where you want it to be when you need to take the money out, whereas opposed to dividends, you're going to get that check every single quarter. So there's a lot of debate internally within the community on which is better, and is it even worth.
Well, I like you can take the Buffett approach, which is just set a systematic 5% income target, sell that many shares each quarter, and there you go. Voila, you got a cap gains distribution income.
Yeah, and you can do it when you want to do it, as opposed to having the forced quarterly. But that being said, you're reducing your share count, which is reducing your ownerships. How do you?
Same thing with dividends, though. It's the same thing with dividends. If you take that income, you got $100 stock and it's paying out $5 in dividends. Well, now you got a $95 stock, right? And so it's the same equivalency. I think people Again, it comes to framing and narrative. If you frame it as instead of income as just distribution, I think people might think of it a little bit differently. But it ends up in the same area. I think the concept of how bonds pay out income, I think people get a little tripped up there. But I think in either case, owning equities, you can. I mean, the whole key is just spending less anyway. We all want to be a millionaire to spend $1 million. That's not what it takes to get to be a millionaire. You got to save and invest to get to be a millionaire.
Yeah. People want to spend like a millionaire, but they don't actually want to save to be a millionaire. That's the difference. All right. So your approach is a shareholder yield, where you look at multiple things. You get the dividend payout, the share buybacks, as well as the debt repayment, and package it all together. And that's what you look for when you're looking at your investments in your account.
Yeah. And it gives you, I mean, we do some other things as we go down the kind of funnel of screening. We run a valuation ensemble. So I want the stocks to be objectively cheap. We don't want to rely on the CEO. We kind of skim off the most over leveraged companies. I don't want them just buying back a bunch of shares or paying dividends with a ton of debt. So somewhat of a quality metric. We even do a momentum sort on the final purchases, trying to avoid the value traps just going straight down. It's interesting where it leads you, though. So all 5 of our shareholder yield portfolios, you end up with single digit or high single digit PE ratios versus the S&P, which is well over 20 on a 12-month, and on a 10-year PE ratio, it's almost 40. So much cheaper on whatever sort of valuation metric you do. I think it's important that people always dive into the methodology. You look at some of the dividend funds out there, some of the strategies, and then you can do this with any fund, listeners. You don't have to believe me. Go throw the symbol into Morningstar, click on holdings, and it'll show you the X-ray of what those underlying holdings represent in terms of P ratio, growth, dividend, all that good stuff. You might be surprised on some of these funds. But the good news is value all around the world looks amazing relative to the market cap weight index. And you could argue over the last 3 or 4 years, and we took out a full page ad in Barron's for this and said, look, if you're not going to do value now, you'll never do it. And it doesn't even really matter which flavor of ice cream you're buying, which style of value. There's such a Grand Canyon wide gap in between the really cheap stuff all around the world and the really expensive stuff, that if and when that reverts, and it doesn't have to, it could keep going crazier, like Japan in the 80s, who knows, you could set yourself up for amazing returns for not just a quarter or year, but a decade or more. And that's actually playing out, not so much yet in the US. It's playing out on a big way in foreign and emerging. We have a global value, deep value ETF, GVAL, that's, I think it's up over 43% this year or something. Now, to be very clear, that sucker stunk it up for a long time relative to the S&P. But my point being is that these things kind of go through seasons where sometimes they do great. But currently, value all around the world looks so much better than the market cap weight in the US.
Yeah, I think, especially for individual investors, a lot of people have just gotten to the market over the last 5 or 6 years, specifically after COVID, and, a couple of bumps in the road since then, but generally it's been straight and up to the right, and the big tech names have been the ones that have been dominating. So that recency bias is definitely real. But
well, look, I mean, US stocks going back to 2009 have been a 10 bagger. And this has been one of the best periods where US stocks have done 15% a year for essentially 15 years. That's only happened 4 times in history, and they all have names. It was the Roaring 20s, the Nifty 50 period, and then the internet bubble, and then whatever we're calling this, COVID meme stock era. Just pat yourself on the back, say it's been an amazing run. However, do not expect 15% returns going forward, because that will very likely set you up for disappointment.
Yeah, I've been personally investing since 1999, so I've ridden through all the different.
There you go, man.
Things that we've had since then. So I totally understand that. 1, it doesn't always go up. 2, it could go down for a very long time, and what worked before doesn't always work forever. So just keep that in mind. Speaking of the new and hot things, these options income ETFs that are out there right now, it seems like there's 4 or 5 coming out almost every single day. Obviously, that's a much different approach than what most of your funds do. Do you have any take on those types of funds, or what people should look out for on those?
I got a take on just about everything. I try not to be dismissive. If someone finds an investing approach that works for them, God bless him. John Bogle used to say something like, look, here's my index approach. Does it work for me? Great. Is it the best one? Is it the most optimal? No. But he's like, I guarantee you it's better than millions of other terrible ideas. I think there's probably some misunderstanding when it comes to these type of funds. I think it's very traditionally retail driven. I think a fair percentage of the population probably doesn't understand that the distributions are coming out of their balance. I think they think you're getting a allowance or a check or like a bond income where you're getting paid a coupon and it's not reducing your account balance. So I think framed that way, it's probably less attractive. I would be surprised if the regulators didn't try to classify certain types of distributions in a way that it doesn't feel misleading, or something you think it's yielding 50%. I don't think people really understand necessarily how that works. I don't think the product providers are in any hurry to clear up that misunderstanding, because they're raising billions and billions of dollars.
Yeah.
But hey, look, if you can find a way to work for it to work for you, good for you.
Yeah, no, that's a good approach. And everything within moderation. Like if you want to put a small percentage of your portfolio in something like that because you like the strategy or you want to take a chance on it, that's one thing. But to allocate your entire portfolio, like some people are doing right now, to the 100% yielders, there might be disaster in your future. So just
there's nothing like a nice, fat, deep or long bear market to clean out all the nonsense. Over the course of a decade, half of all mutual funds and ETFs disappear. And so, I think particularly in the bears, a lot of the nonsense tends to go away. We just haven't had one for a long time. We'll see. We may never have one again. I don't know. But if we do, I imagine things will get cleaned up quite a bit.
Yeah, it's really sad because a lot of these, newer investors have only been doing it for the last couple of years, where you've had access to these high yield products. They think that's what investing is. And when, to your point, there's some big shakedown coming in, all those people are going to leave the market thinking it's a scam, and they're not going to be able to take the benefit of a long-term compounding of investing. I mean, again, I've been investing for 26 years, and my net worth has exploded because of my steady approach to investing over time. But if you get out and say it's a scam or never get back in when there's a big downturn, you're never going to build that generational wealth like I'm trying to build personally. So you got to think about that.
I think the hard part, and speaking exactly what you're talking about, is the vast majority of investors just don't have a plan. They just wing it. They buy some stuff, see how it goes. They look at it after a year or two. They sell whatever's gone down. They keep or buy more whatever's gone up. And that's problematic, as you know, because a lot of these regimes and eras can last quite a bit longer. And all the academic research shows that people are absolutely god awful at timing their investments, chasing the hot winners. And they do this over and over and over and over again. So I think the first and best thing people could do is write down a plan, just like a diet. Go give it to your spouse or child or grandparent or neighbor and say, hey, try to keep me a little honest here when I'm talking about buying fart coin, or I want to put all my money in prediction markets, or I want to buy 195% yielders. Talk me out of it, Exactly. But I think that's tempting. It's very seductive.
Yeah, I've been preaching that for years. A couple of years ago, I did a video on an investor policy statement, which is very similar to your plan, where you need to document what you're going to invest in, what you're not going to invest in, what sectors you want to look at, what yield you're looking for, what total return you're asking. Are there companies you don't want to invest in? Like a lot of people don't like tobacco and things like that. So having a plan in place will keep you from chasing that shiny object that someone on YouTube talked about, that type of thing, which is what a lot of
kind of like, the advice when you're angry about something, you always tell people just wait 24 hours. I think that's like probably pretty good advice in investing too. Is like your neighbor gives you some hot stock tip. It should almost be like a month. Be like, okay, but you got to sit on this for a month. Chances are you're going to forget about it. Most of this can be put on autopilot, which is the beauty of ETFs. Is the beauty of automated programs, target date funds. And then it's just kind of boring, which is the way it should be. You want it to be sort of boring. You think it's fun and do a little work on it. Great. That's your interest. But I think the biggest struggle for all of us is getting in our own way.
I totally agree. So speaking of making it a little easier, you guys do have quite a few ETFs. I definitely want to mention a couple of them. The ones that I like the most, and I think the most relevant to what we're talking about today, is SYLD and FYLD. Those are your shareholder yield, both domestic and international. Can you talk a little bit about both of those and kind of your approach to them, and we'll go into some of the details?
Yeah, these are teenagers at this point. They've been around since 2013, which is sort of crazy. We have 5 shareholder yield funds. SY is the US version, FY is the foreign version, and then there's EY, which is the emerging market. They all buy 100 stocks. They rebalance once a quarter. Interestingly enough, they end up in very different places. So, for example, the US fund owns very little tech, but the emerging market tech has been one of the largest sectors for quite some time. Just going to show there's regional geographic differences based on what's going on in the world. They end up in a pretty diverse set of cap size and sectors. It definitely skews a little more mid and small currently, largely because of the opportunity set. One, there's more companies in mid and small. Second, mid and small have vastly underperformed the S&P for a very long time. So it creates a lot more valuation opportunities as opposed to something trading at 200 times earnings or revenue. And so, these type of funds end up with a value quality tilt. Sometimes that means they are going to diverge quite a bit from what the index is doing. But over time, and we take this back, 100 years, and a friend takes it back 200 years, modeling out some of these ideas, and historically they work great. We've tried it in sectors and industries. So if you want to run shareholder yield in gold miners and tech and utilities, historically it's worked great in all these regions and sectors as well. The big takeaway is that you just never know when. So for example, this year, the FY and EY are the ones that are up 20, 25, 30%, SY being on the lower end of the single digit return scale.
Yeah, but that being said, SYLD over time, I think over the last 13 years or so, it's been averaging over 10% total return a year. So even with all the ups and downs and the hot things coming and going, you guys have still been able to produce a very solid, stable return over time. So your shareholders are still benefiting from it, and you don't have to pick and choose like what's the hot thing this particular week or month or whatever happens to be. And you're paying a solid dividend, but it's not the main priority. It's that total shareholder yield that you're looking for.
Yeah, it's look, it's our oldest fund. I like all my kids equally, but a certain fondness for the oldest.
Yeah.
SYLD is that one.
Yeah, no, it definitely makes sense. And I'll put all the information up on the screen. Now, it is an actively managed fund. Obviously, you're picking, approximately 100 different companies based on your criteria. The expense ratio is modest at 0.59, which again, for active fund is very reasonable compared to what else is out there. And I do like a lot of the names in there. And what I really like about your fund, SYLD in particular, is the companies in there are very unique compared to what some of the other dividend-focused ETFs are offering right now. So you don't
But
really.
here's the nice part is I often don't like the companies in there. I look at that and I'm like, ugh, gross. We own Dillard's. I was like, the last time I've been to a Dillard's was like 25 years ago. But I think a lot of the research, and Joel Greenblatt talks about this, is when you're left your own devices with a computer versus discretionary, the problem a lot of us have is we see that revulsion, and it actually usually works against us often because there's a bias in there somewhere. So that's the beauty of letting the computer pick it for me.
Yeah, exactly. So I did a video on this recently, and what my focus is this year is finding the best quality companies, dividend payers, no matter what industry they're in, whatever company it is. It doesn't really matter to me. I may not know anything about it besides what I've researched. I may never have shopped there before. I might actually dislike the company, but the numbers don't lie. And so if the quality's there, the valuation's there, all the boxes are checked, let's go with those. And so that's really been my focus this year. And so far, so good. I have a portfolio of about 35 different holdings that I've identified. They're, in my opinion, top quality based on all the different metrics. And so to your point, like you don't have to like the stocks, but they're the ones that are hitting the criteria, and they're the ones that are more likely going to perform better than the ones you might love, that type of thing.
I hear you.
Okay, so with that, where can people find more information on your funds, as well as looking into your research and your insights, if you will?
Day job is cambriafunds.com. That's easy. You can find a lot of research there, as well as on mebfaber.com, which is my blog. You can download the books for free, a bunch of white papers. We have a podcast, the Meb Faber Show. And of course, watch me pick fights on LinkedIn and Twitter and elsewhere.
Exactly. And I follow you there as well. And I'll make sure I'll put up all the links on the screen after we're done here. Yeah. And I also know on your podcast, you have a audio version of your Shareholder Yield book. So if someone doesn't want to actually physically read it, they can listen to you go through it. So I've done that a couple of times as well. So that's another approach someone can take to get more insights from yourself and kind of your approach to things. And if you like what Meb has to offer, definitely go check out their website, check out their fund, see if it fits for you. But Meb, thank you so much for joining us today. Really appreciate it. And hopefully we'll talk soon.
My pleasure.
Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.